Okay, welcome everybody. Thanks again for joining us. We'll see if we can't make things a little more interesting today. You had pretty good movement in the euro, pretty good sell-off down, and we could show you how that would have been somewhat simple to identify that, and hopefully that'll make it a little bit more exciting. But I think our primary point here is education. I think we have to stay on point there. Welcome to Live Market Exercise. My name is Jay Norris. As always, we have to run a disclaimer by you guys. Keep in mind, trading Forex is a risky endeavor and not suitable for all investors, all individuals. It really is true that if you have bad habits in life, they tend to be magnified in your trading. Trading is probably the best self-analysis you could do. It really is. You find out so much about yourself. You also learn the absolute importance of keeping things simplified today. That was a good lesson for me today. I kept reminding myself, keep it simple, don't complicate it. And we'll show you a little bit about that. My name is Jay Norris. I'm a 20-year trading floor veteran. I spent a lot of time, basically I grew up on the Chicago Board of Trade. I started there right out of high school, and I'm very, very lucky that I was born in Chicago because that was an opportunity for me. I'm not sure what I would do for a living if I wasn't born and raised in Chicago and I didn't get a job as a runner straight out of high school. I'm also a professor at IBUniversity, where I spent a considerable amount of time teaching and demonstrating the art of discretionary trading in live markets. The methods we teach are both mechanical and behavioral, and they're mechanical in that we provide a framework, we provide a sound methodology that we use to determine your overall price pattern and overall direction, and they're behavioral in that we definitely take into consideration behavioral elements of trading, namely the fundamental inputs to trading. Overall, we tie it all together, though. We understand that everything that happens fundamentally in a market, be it natural, socio-political, certainly economic, I'll wrap all that up, and it's definitely going to show up in the price pattern on the chart. So what we teach, both mechanical and behavioral, I think that's important. Also, you'll never hear us say it's technical versus fundamental. It's to us, it's all the same. It's one system, the market. Before I cover how we can help your trade selection, a few words on methodology. You have to have a robust trading method, which works in all environments. It's absolutely the first thing you're going to need if you expect to trade successfully. It took over 4 years to put together a trading course that, for me, to teach an objective empirical method that you can use in all trading environments, meaning up markets, down markets, sideways markets, regardless of the shifting fundamental conditions, etc. Well, today you're in nothing but a down market for the euro and any euro pair also. But it's important to know that if you are going to trade overall, you're going to need a method for all seasons. And we'll come back to that. Before I bore you, though, with the methodology, I want to go to the charts and show you what's going to happen in the euro. Show you, what's happening in the euro right now. So let me, and also ask you guys, how many of you guys, there you go, hopefully you're looking at a euro 15-minute chart. I'll bring down a 3-minute chart and show you how we would have handled this. But how many people in the room traded the euro this morning? Put it this way, how many people traded the euro and you're very happy with your results? Oh, come on. You guys are modest now. Okay, well, here first, here's your 15-minute euro chart. You could see that you had a basically price collapse there. I'm going to tip you off, too. You've heard us talk about the importance of 50% retracements, right? Okay. Hey, Boyke, how are you, buddy? Let me reset my camera here. Okay, there we go. Okay. You guys have heard us talk about the importance of a 50% retracement, right? See the purple line on my chart? Anytime you see a purple line, that's going to be a 50% retracement. So when I go down to the 3-minute chart, you can see that purple line is still there. Here, I'll put a purple line on there so I can get rid of all those other lines. So I get rid of that retracement framework. Now, I wasn't terribly bearish. The euro, sometimes I could be faulted for looking, for overanalyzing a market. I follow the stock market. I follow the Aussie pairs. I noticed she had a pretty good a couple of day uptrend in the stock market. Also, the Aussie pairs, I saw that the euro had consolidated around 25 even. Wasn't all that bearish on the euro. This is a 3-minute chart, by the way, and this is a 50% retracement just to show you where that came from. You just take top to bottom. There you go. Snap it on there, and you can see that's the 50% retracement. So when I see that crown formation on a 50% retracement, and I also know that the euro happens to be in a situation where it's not even arguably that your grand pattern's down, your primary pattern's down, the secondary pattern's down, your day-to-day pattern is certainly down. Day-to-day is probably your most important pattern because that's a reflection of day-to-day news events. So really, I'm not so concerned with my higher time frames. I'm concerned with that day-to-day on down, but your day-to-day was down, your micro was down, everything was down. Now, I'm not so bearish on this market because I see it consolidating right on top of 25 even here or so. But when I see this formation, essentially a head and shoulder top or a crown top, whatever you want to call it, when I see the market can't get through 50% and I see what we call a change of direction here, and then it can't change direction back higher. See, I'll show you this. We'll go back to the presentation and define that better for you. But that's a change. That's what we call a change of direction candle. And then it can't reverse it back higher. You can't close above the high, that low close candle right there. Brother, that's a signal that you got to get short. Now, I wasn't expecting the big move down. I just thought we'd see a test of 25 even down here. There's a pivot down there too. Sure enough, you got it, and they just kept on going. So simple stuff. This is the net. This is what should be the net effect of our courses is that you're catching moves like that. Again, I'm not even that bearish on the euro. But when I see that, I'm like, ho hum, I got to be short. And that's really how that trade felt. You get short, oh, well, ho hum. Look at very limited risk on the trade, too. I think my stop was 51 or so. I could have even had it closer. I've just put it above the 50, the half level there. But it could have been even closer, never even challenged the stop, and boom, that was a heck of a trade. So that's why you want to tie it all together. So, I'm glad to show you that. Let's go back to the slide, and I'm going to ask you another question. Yeah, I do. A market timer, do I use a 3-minute as my entry? I use a 3-minute. I'll use a 1-minute. But it's not the entry that's important. It's how the patterns are aligned for it. Euro, it was kind of a dummy-proof trade because all of the patterns were lying down. And you know what? Even if you're sitting on even if you had a good month, it's the end of the month, you just go back to a 3-minute chart here. It's hard to say no to that little head and shoulder top on a 50% with all the patterns down. So yeah, market timer, I'll use a 3-minute in that case. Sometimes even a 1-minute. There's nothing wrong with a 15-minute either. But any method that you use. Oh, you're very welcome, sir. Any method that you use, it needs to be simple, in your mind anyway. It has to be intuitive to you. You need to be able to easily explain it, or who's ever teaching you needs to be able to easily explain it. Now, let me ask you guys a question. I know some of you guys have sat through the webinar with us in the past. What do you guys think is the most important aspect of trading? Go ahead, pop it right out there. What's the most important thing you need to know that you guys think about trading? Well, there was an article on I think it was in Bloomberg. Hey, trying trader risk. I would have overlooked that. Trying trader said Risk. Boyke, right? Spot on, right? Keep it simple. Rob Smith. Yeah, all you guys are spot on. English. Risk, trade management. Absolutely. Consistency. Patience. You guys are spot on. What I was thinking was price pattern. You guys had popped out risk first. You're ahead of me. I think that's a better answer. But from my perspective, in teaching it, and I think for a lot of people to learn it, Boyke, discipline, absolutely. To me, it's price pattern. I was reading an article in Bloomberg not that long ago. I think it was the tail end of last year, and it was talking about how a lot of the big Wall Street shops were out there, and they were recruiting chess masters. And they were recruiting chess masters because, by the way, I'm not a chess player, but they were recruiting chess masters because, as the head of J.P. Morgan's trading unit said, after all, it's all price pattern. He said it's all price pattern. Boyke said it's a trend, my friend. You bet it is. The trend is your friend until it isn't, right? Now, for me, there's a difference between the trend. There's a price pattern, there's the trend, and then there's direction. But price pattern, extremely, extremely important from our perspective. And the most important, your most influential price pattern is going to be that the price pattern is creating the current news flow. But I will say you guys gave some great answers. I love this crowd. You guys are ahead of it. And Boyke, I heard what you said last time. You wanted to show something new. So we'll try to do that. I don't want to have to charge you admission, right? We can't do that, right? So let's see if we can keep it entertaining for you. Yeah, I love candle patterns. Absolutely, absolutely. But you know, it's got to be if what you're doing, if you have a trading plan, you need to be able to explain it pretty simply to your buddy. Whatever method you're using, you know, it has to be intuitive for you. So that being said, if I had to summarize what we teach, the 3 points would be: use pattern recognition to identify a market's growth pattern. Now, I don't think you need to be a chess champion, such as J.P. Morgan believes, or a chess master. To me, I think they're still going in the wrong. I think they're going in the right direction, but I just don't think they're on the right road yet. I think you have to keep it simple. Who's it, Boyke? You said keep it simple, stupid. Yeah, absolutely. We're all really good at pattern recognition, whether we know it or not. So use pattern recognition to identify a market's growth pattern. When I say growth pattern, we mean it's pretty simple. The market's either going up, it's growing, or it's going down, it's contracting. Sometimes you could be going sideways, or you could even have a correction. But if it's a shallow correction, then we understand that market's just taking a pause in between the growth cycle. So we can discern a lot from just glancing at the chart. I'm a big believer that you can overcomplicate things. Me too. I always have to remind myself every day not to overcomplicate it. But the computer can really overcomplicate it for you. So the 3 points I need to make: number one, use pattern recognition to identify a market's growth pattern. Pretty simple. Is the market going up or is it going down? Number two, use the scales of those growth patterns on the lower time frame charts to identify buy and sell zones in line with the higher time frame patterns and the day-to-day news flow. To me, the day-to-day news flow is a pattern in itself. It's what we call the day-to-day pattern. So your day-to-day pattern, and we'll show you that when we're back on the charts. Just keep it simple. Look at 2 weeks worth of data on a 4-hour chart. You're going to be able to see the day-to-day news flow. As interesting as Aussie yen was looking to me, as interesting as the U.S. stock market was looking to me, having recovered some gains, some losses, and stocks were looking pretty good, but I knew that the 2-week pattern was still bearish. So I knew if I still have a 2-week pattern in the market, I can't go long those markets. So that's why I was bottom fishing in the euro and happened to be there when we had a head and shoulder top on a 50% retracement. And even though I'm not all that bearish down here, that'll teach me, because guess what? That market's quite a bit lower now than when that signal fired. 25.37. Now it's 20. Wow, it's 70 pips lower. So there you go. I don't have to think. All I had to do was take that trade. I'm happy now. So use the scales of the growth patterns on the lower time frames to identify buy and sell zones. And that 50% level I showed you, that's what we call a buy or sell zone. In that case, it was a sell zone. So the 50% marks the bottom of a sell zone. So if you get any kind of formation, any candlestick formation, bearish pattern, head and shoulder top, whatever you want to call it, rising wedge, double top, triple top, crown top, any kind of formation like that in a zone, that's going to warrant interest for us. And number 3, in describing the method that we teach at IBUniversity, provide a fact-based trigger to enter and exit trades and show how you use news and momentum to filter your trade selection. And that's what we're going to be showing you today. Also, when you refer to the term scale in that second point, you guys, scalability is a very important thing. A scaled pattern is one where the sum of the parts equals the whole. In fact, the parts themselves are scaled replications of the whole. We use these scales or retracements in trading terms to identify buy and sell zones. That's why we essentially had a sell zone in the euro. All the patterns are down. You can't say no to that trade. Now, what's going to help you at this point also is understanding that different time frames are essentially different dimensions in time. And this is a tough one to teach people because we're used to thinking in terms of just one dimension. In learning to trade, granted, it's been simple in the euro because it's been a one-way train, but at some point you'll have a market that you follow and you're going to see two-way trade. And then at that point, you're going to have to be able to see the different dimensions simultaneously. And that's something we spend a considerable amount of time teaching, and that's important for you to know, that it's not just one-dimensional. Trying trader, how can we become very good at recognizing patterns? Just identify the patterns that produce winning trades. Identify those patterns that didn't produce such good trades, that produce losing trades. But just look at that pattern to see, anytime you have a market breakdown or a breakup, look at what pattern was there before it occurred, I would say. 2 weeks, pattern is long-term, direction is very short-term. I hope I showed you guys the change of directions in that euro this morning. So 2 weeks data is going to give you the 2 weeks 2 weeks on a 4-hour chart. Boyke will give you the day-to-day price pattern. That's very important. That's the news flow. It's going to show you which way the news is flowing. So that's for pattern. Direction, you can change direction with one candle, by the way. So it's going to be important long term that you understand there's different time frames out there. There's different dimensions. And also I might point out too that everyone thinks that the long-term patterns are the most influential. Well, there's times that they are, but that day-to-day pattern to me is the most important pattern on the chart. Also, your micro pattern, extremely important, much, much more important than when Dow wrote the book, The Dow Theory, which to me is the Bible, by the way. And, back to that question, what's one of the most important things to learn in trading? You guys hit it on the head. Some of your stuff was even better than mine, but from my perspective, it's price pattern. Now, what does Elliott Wave, Gann, Dow Theory, what do they all have in common? They all have price pattern in common. So price pattern, very important for us. Also, you need to know the difference between analyzing and trading. You need to learn how to analyze the market first before you could trade the market. I'm sure I've told you this before. If you ask a guy, what is he, an analyst or a trader, he's going to say trader. If you ask a woman, the question is, what's more important to you, to be an analyst or a trader? Guys say trader, women say analyst. Women understand that you have to have a plan before you can execute. The correct answer is what's more important, analyst or trader? Analyst. You have to be an analyst before you can be a trader, for sure. That's very important. So I told you a little bit about my own philosophy, how I focus on it, where price pattern is so important, and also as someone said, the candle, the short-term candle formation is very important too. That helped me today too, because you can't say no to a head and shoulder top against a purple line when all the patterns are down in that euro, and boom, you saw what happened there. they tore it up pretty good, right? So really the question comes down, how can we help to improve your own trade selection? I know that's why you guys are out here. So let's see if we can do that. I learn every day. I've learned so much in the past year alone. But what I learned most important when putting together our courses for Trading University is know when direction is aligned with price pattern. Short-term direction can be up, down. It can be all over the place. It can change in one candle. One candle doesn't make a trend, but one candle can change the direction of a trend. So it's essential that you understand that. Knowing when direction is aligned with price pattern, it also proves to be a trade for us. That's how we determine when to enter a trade, when to exit a trade at IBUniversity. It's when direction is aligned with price pattern. Now, before we go any further, we've got to. I love to dummy things down so that I can understand them and everyone can understand them. And I think we're well suited too. I think we're well suited to learn when we take things in incremental bites like that. So before I could show you examples of a direction aligned with price pattern, we have to define both for you. So price pattern, pretty simple, but you'd be surprised how many people don't take advantage of it. Trying to trade, if I'm a day trading, how long back in time should we consume with support and resistance? Support and resistance, that's structure. Structure is pertinent based on what time frame it is. If the market's on top of secondary structure, then the secondary structure is important. But basically, you're saying how relevant is support and resistance. It depends on the time. It depends on the pattern it's drawn from. I hope that helps you a little bit. It's important that you know which support and resistance levels are relevant. Price pattern, pretty simple. People don't take advantage of this enough. Price pattern is the pattern created by a market's highs and lows over time. It's just a matter of marking the isolated high points and low points on the chart and identifying that the market is exhibiting a bullish or a bearish pattern over a specified length of time. Here we see a pattern of lower highs and lower lows, i.e. we have a bearish pattern in the euro. And this goes back over the last year or so. Well, today, look where we're at now. This chart, we made this chart at the beginning of April when we first joined you guys. Now look at prices down below 25 even. So you have to ask yourself, if you're following a method, how is it that you didn't get a piece of that, from 33 here down to 24? That's a 900 pip move. So hopefully you got a bit of that. Even if you didn't get a whole lot of it, as long as you got a little bit of it and you're learning and you're feeling you're making progress, kudos to you. Trading is like so many of you guys point out, the importance of risk. Trading is not losing. Okay, trading is learning to control your risk and not lose. Once the winning will take care of itself over time. So here's how important price pattern is. We knew at the beginning of March. And this chart was a snapshot at the beginning of April. So we knew in March that you had a bearish pattern. No surprise, the market's 900 pips lower now. So price pattern, extremely important for us. That's a picture of a bearish pattern. Here's a bullish pattern. Here's the U.S. stock market. And here's a bullish pattern, higher lows and higher highs. This, again, is your U.S. stock market. That's your S&P 500. The S&P, a very influential market. We call it the alpha market. But you know what? Things are so bearish in the euro that regardless of the patterns in your asset class markets, in this alpha market in particular, they don't matter. Stay on that euro. It's down on all time frames. You have overwhelmingly bearish news. You got to stay on that. And any experienced trader will tell you that buy strength, sell weakness is extremely important. So as long as there's still bad news on the horizon, as long as that euro is still going down, stay on it. Keep on beating. Here's a price pattern in the stock market. We want to make the point that it's so important, that price pattern, more specifically the growth pattern. What's really exciting about that growth pattern is that they're scalable, meaning the smaller price moves here we see on the left side of the chart are essentially scaled replications of the larger price moves. So knowing when price direction has shifted in line with that dominant pattern is critical for us. It's these points right here. when we see a change of direction in line with that overall pattern, that's where we want to be. An even much more simplified way to look at this, I love to simplify things, you guys should too, is we're looking to buy dips in an uptrend. Identify an uptrend, look to buy a dip. Recognize that markets bottom, another way to say a market tops or bottom is a market climax. Understand that market climaxes are going to be counter to the overall pattern. So when we see a market climax and it's still above, it's less than 2/3 correction, for example, or even better, it's right on a 50% retracement, you got to consider that as fast and hard as that move looks, as much as you want to think that market's reversing, you have to understand that these are just climaxes. When that market climaxes, you want to be aware that if it climaxes on a 50% retracement, that's good stuff. So really you're going to focus on, again, very simple, when direction changes in line with the overall pattern. Scalability, very important. And you guys were asking about pattern recognition before. In order to understand in order to recognize the patterns, you have to understand the nature of scalability. It's really easy to overlook basic patterns, especially if you're focusing on technical indicators or crowding the charts with other overlays. But if you know how to recognize those higher time frame patterns, such as that, it becomes much easier to understand and even expect these same patterns on the smaller scale. There you can see on the white on the right side of the chart, and then even the tiny pattern here on the far right, where it's basically the same pattern. It just continues to repeat itself. The really good news here is not that markets exhibit scalability, also known as fractal geometry. In fact, they typify fractal geometry. That's good news, but the really good news is that we as individuals are naturally very good at pattern recognition. In fact, it's one of the things we're still better than a computer at, and that's simple pattern recognition. While each pattern a market creates is wholly unique, it's generally a slight variance from the previous pattern. That slight variance doesn't mean much to you or I or even a kid. He can recognize that immediately. It's just a slight alteration of the pattern, essentially the same pattern. We recognize these easily, but it really throws the computer off, which is the computer only knows to look for what's been programmed into it. So the computer's not going to do it for you. You've got to understand what you're looking for first. You've got to know, if you're relying on the computer to tell you how to do it, I think you're in trouble. I think you need to know how to do it. Then you can perhaps instruct the computer on how to help you do it. The computer, to me, you could still, I grew up where you had to draw your lines on the physical charts. We had a paper chart. We had to update the bar chart. So to me, it's the same thing. The computer is just an extension of that. To me, a computer is just like a typewriter, I guess, or Etch-a-Sketch. The computer's not going to help me figure out how to trade. The computer makes it easier, though. That's for sure. So this is why Wall Street doesn't make its money from betting on which way a market's going to go. They make their money from taking the other side of all our trades, that is being market makers, and from getting paid the transaction cost, also known as commission, or in Forex, the PIP. The brokers will forever make their money as making a market for us or charging commissions. They're not in the business of rolling up their sleeves and becoming traders. And I still think J.P. Morgan's they had the wrong idea with recruiting those chess masters. I think those guys are just complicated. They'll think it's like gamemanship, and there's no gaming in trading. You can bluff people when you're playing cards. You can't bluff the market, though. I don't even think there's gamemanship in it. To me, it's just flat out simple pattern recognition, being on your post when you're supposed to be, right? You don't leave your post. You show up with your lunch pail next to you, and you wait till it's time to get in the trade. Once you get in the trade, once you set the stop, guess what? Then you can walk out. When the euro was breaking down, I was out watering the garden. Because once the trade is on and stop is placed, it's okay to walk away then, because guess what? By walking away, you lessen the odds of making a mistake. If the longer you're on the screen making trading decisions, the more likely you are to make a mistake. So you know how you don't make a mistake? Get in the trade, put the stop on, walk away. There's nothing wrong with that. come back at the close of the candle when you have to reevaluate it. So I hope let me stay on point here. Scalability it's a beautiful thing. When you could start to anticipate that the overall pattern, that what you see on the higher time frames is just going to continue to get replicated on the lower time frames on the right side of the chart. That gives me a lot of comfort as a trader. Scalability repetition, another great quality of price movement, along with being scalable, is it's repetitive. Bam, bam, bam. Look at that. The study to describe that repetition is called fractal geometry. Once a growth curve is established, be it positive or, in the case, negative here, it tends to be repetitive, as we could see in this Aussie dollar chart. And that Aussie dollar is back in March. And that would continue to be repetitive throughout April and May. You still have a pretty bearish pattern, pretty bearish lean to it, although you did have a nice correction and you just climaxed on support in that Aussie. Maybe we can take a look at that in a little bit, right? Now, of course, everyone's going to ask themselves, why does the market have a negative growth pattern to it? Why does it have a negative growth pattern to it? I tell you this joke all the time. Why? On a trading floor, the answer is who cares? Well, the answer is really not who cares, because a lot of people do care. They want to know why something is doing what it's going to do. It helps them to understand it, too. So to a degree, it is true that who cares? You don't need to know that. But to a degree, I think it helps people understand why something's happening. And the why of this market giving a negative growth pattern is that you're seeing negative economic data. Inevitably, what you see on the chart is a reflection of what's going on fundamentally in that market all the time. So you need to understand that for sure, and that's going to help you out tremendously when you don't need to read every article when you understand that, oh, there's negative articles out there. The pattern's negative. The pattern's a reflection of that. So all you need to know why the pattern's down, because there's a negative news flow out there for it. And that's what I was talking about, you guys, when I was telling you, show me two weeks worth of data on a chart. I mean, I could see, here's 2 weeks, it's kind of bullish, but then, you have an uptrend to it. But then look at what happens here. You have a lower low here. It breaks down. You go back, from here, really midweek, you go back 2 weeks, and then the pattern's negative. And then the pattern's been negative the whole time. So 2 weeks on a 4-hour chart, very good stuff. It's going to show you the day-to-day flow of it. Boy, do I set targets? Sometimes, yeah. I set targets based on a percentage. Sometimes I'm a little too consumed about, I think everyone tends to be concerned about their performance in the account. So a lot of times I'll jump out a little bit early. I happen to like 12.5 pips. I like 12.5 pips because 12.5 pips on a 4 lot is 50 pips. 50 pips on 50 pips is 1% of a $50,000 account, right? So I tend to like targets for reasons other than I really should. I like targets because, if you can grab 1%, 1% on a trade in any given day is a good day, right? That's 1%. So I don't set the targets per se, as far as specific levels, but they tend to be in increments of 12.5, 25, 50. One of these days, I'll learn to just let a profit run and not even be concerned about that. The problem with, when I'm in a counter-trending market, and, even today where, the euro was going down, the euro was trending down. There's no way you were in a counter-trending market. The euro's in a bear market, flat out down on every time frame. But I'm still a little concerned that the other markets were up. So that's when I'll come out of a trade early if I see the other markets are holding up. But, that was a mistake today. I should have just let that euro go. So set targets, Boyke, I'm hesitant to talk about it. I do it. More times than not, I get out of a trade too early because I do. But you know what? As long as you're making positive pips and at the end of the month, you're good. At the end of the quarter, as long as you're going in the right direction. I need to probably get away from setting targets though and just have faith that that pattern is going to continue. But scalability, repetition, extremely important. again, when direction shifts in line with the pattern, that's what's important. And that's all we marked right there. So, I mean, it's as simple as find a pattern, wait for that counter trend line to give way, the bullish counter trend line, let those give way, and then get short in line with the pattern. These, by the way, are called change of direction. Here's where we get boring because it gets a little technical for you. And a simpler way of looking at it is you're selling rallies and not a downtrend, right? So you're selling rallies and a downtrend. Yeah, absolutely, Boyke. Put 3 on. Put 3 on. Take 1 off. Let 2 go. Take that second one off at, like, for instance, even. Maybe you take it off at even in the euro. Let that third one go. And now euro's down at 24.72 already. So they just blasted that thing lower. Yeah, you definitely want to trade multiple contracts, Boyke. So then you have the freedom to do that. So when direction shifts in line with the price pattern, here you see it again. And here's an example in the euro most recently. There's the change of direction there. Now price is all the way down here, 24.72. So you can see price, in fact, did continue to go lower. That's what you look for. That's a change of direction in line with the bearish pattern. So change of direction, here's what we came for. This is defined in the book. A change of direction is a trend line break plus a directional line shift. Now we have to teach you what that directional line shift is. Let's define the directional line. It's the low of the highest closing candle in an uptrend and the high of the lowest closing candle in a downtrend. And this is also a pretty important trigger for us. So you guys want to write that definition down. And basically that's what I couldn't say no to that in the euro when you had that little head and shoulder top against a 50% line, and it looked like it wanted to go test that even level. In fact, that's what it did. So it was that change of direction. Basically when the low of the highest closing candle was eclipsed, that was a signal. How our directional lines are used, and there's a directional line for every time frame. If price is closing below the directional line, direction is down. If price is closing above the directional line, then the direction is up. So keep it simple. If you think about direction in terms of the chart, think about direction as short-term trend. Direction is your very short-term trend. Your shortest-term trend is direction. Your longer-term trends, that's pattern. Pattern is different than trend. Trend tends to be current direction on a time frame, where pattern a little bit longer term. You need more data on the chart for the pattern. Change of direction equals a reversal. The bottom of the chart, there's your definition of price reversal equals a trend shift and a directional line shift. And this is the directional line is in white. This is a weekly chart, so our directional line is in white. That's the highest closing candle. We marked the low. We slashed that. We put the low of the highest closing candle. When you eclipse both the low of the highest closing candle and the trend line, that's a reversal. Same down below here. Here, let's go back up here. You can see I highlighted that directional line shift there, and we highlighted it here too. You close above, in this case, you close above the high of the lowest closing candle, not the lowest candle, the lowest closing candle. Very important differential. This is the lowest candle. That's the level you've got to eclipse. So you eclipse that trend line and that's what we call a bullish price reversal. It's a change of direction. If you want to learn more about that tactic, that directional lines, take it to Chapter 3 of Go Get Mastering Trade Selection and Management, which, by the way, is a textbook it's our textbook for our advanced course. There's very, very good stuff in there. You can check it out there. Let's go back to this Euro chart, and we could show you some examples of the change of direction we had here. And also I want to show you the Aussie Yen chart too. Okay, we're back on the Euro, and here that's a 15-minute chart. And hopefully you guys understood how that directional line works. Let me automate it for us here. I'm going to cheat. I've got them automated, so I'm going to cheat, and that's easier to show it going through time. I'm just going to leave my 15-minute directional line, and you'll see how effective that is. Because the directional line is the trigger. I think the pattern, you guys are naturally, you'll get good at that. But you guys really want, action, don't you? You want that trigger. So I caution, okay, here's my 15-minute directional line. I caution you with that trigger, though. You better be a good analyst before you're a trader, right? Let's go all the way back here. See the blue line? That blue line is automatically marking the low of the highest closing candle. Now, one more, on the opening of that next candle, the line's going to move. So it marks the low of the highest closing candle. It doesn't shift the line until the close of the next candle, unfortunately. So it looks like it's lagging, but it's not, though. You know that this line's going to move to there on the opening of the next candle. There's a change of direction right there. See how price closed below the line? I go on alert now. You know what? I don't even need to see what kind of retracement that was. I could see with the naked eye that I'm probably a little over 50%. Just to see, though. You don't want to get caught up in the there you go. See, the purple line's 50%. So that's pretty sweet right there. Don't get caught up in the exact measurements of those retracements. As long as you can see that this is a lower high than here, you're good. So you have a change of direction there at 3 a.m. In the London session this morning. 8 a.m. My bad. 8 a.m. in London, you had that change of direction. That's going to be significant. I want to know when that occurs. Now, see how my line is that's the 15-minute directional line. See how it became resistance there? It held below there. As long as price is below that, as long as price is below the line, the direction is down. I'm not sure where these other lines are coming from. There you go. That's a change. I like seeing that because that tells me, hey, I'm going to get a shot at selling another rally. Honestly, I wasn't that bearish on this market, but here, let's break it down to a 3-minute chart. So I'm looking for my highest closing candle in here, which is right here, it looks like. That was it. So once I close below that low, right here you have a change direction. Hopefully you guys can see that. Right here's a change of direction. You close below. So I'm on alert that the only way to be is short at that point. Now, you had all the numbers out then. Yeah, I think all the numbers are out here. So here's a change of direction. Now, I put the stop below. If I see 25.50 is that close, I'll put that stop behind the half. I'll put it at 51. That's a good thing because you don't want to get up there on one tick. They stop you at the top. Here's another change of direction. See, here's the highest closing candle here. Once you close below that, that's a change of direction right there. That's the one I was focusing on. It's hard to say no because at that point, here's what I'm looking at. I've got at least a double top. I've got a double top on a purple line. You have to take that change of direction sell signal right there. Here's another one. See, you never got, this is the change, the COD here, we call it change of direction. You never could close above that high again. And that's when the market started taking off lower. Look at that, bam. And it's just, we're putting everything together there also. So hard to say no to that. Boyke, it can't. He said it's 3 minute too noisy. You know what? How you eliminate noise? Don't look at the chart. Just put the stop in and walk away. No, I don't think that. I like the 3 minute, but I'm not going to use the 3 minute time exit. I already know that I'm looking for a sell signal based on the pattern, and I just want to get in as quick as I can. I won't let that noise get to me. Well, this is just such a powerful bear move here that there was no noise. Just look at your moving averages were perfect. They just kept you down. So no, I don't let the noise get to me. I'm just using that 3 minute to exit. Ideally, I'm going to manage the trade on a 15-minute using a momentum indicator. I use the momentum indicator to manage the trade, or just that moving average too to manage it. There's a market I want to show you that's kind of interesting. I don't want to go over my allotted time. I'm looking at Aussie yen long term. I'm kind of enamored with this market. You see how every time you get down towards 75, that's a heck of a buy. And, this is a market where I think the demographics are such that, at some point you're going to break out of this range you've been in. I think you're going to get a pretty big move out of here. We'll see. That's certainly not going to happen if you have a slowdown in China, though. That's a big concern. Get to that 15-minute. But I'm always enamored with this market because I think that you get in. Elements low. Jay, sorry, I can't remember. Which period are those moving averages from? Oh, those are proprietary numbers. We don't give you those. Yeah, you should be able to figure them out, though. But no, I apologize. I can't. Much of what we teach is proprietary. So, but I tell you what, I'm enamored with this, with the Australian Aussie yen. And when you look at it on a 4-hour chart here, you still have. What's my rule of thumb? If you have a 2-week bearish pattern, there's nothing to do, right? So if you go back 2 weeks here to mid-month here, you're still bearish. You could still see, you have a pattern of lower highs here. But, by virtue of time alone, if you had a decent week and this market just went sideways, maybe eclipsed that high a little bit, this is a market that's in an interesting position that you could see a shift here. And you already had, let me see if you got to change direction yet. No, not yet. See, this is my lowest closing candle right there. Look, if you draw a line on the top of that guy, let me put it on there. There it is. See that yellow line? That's resistance. So that's a level that I'm watching for if you get a change of direction on the daily. In line, by the way, and what's the overall pattern here? Well, it's kind of hard to say. If you go back from October, you're still exhibiting higher lows. So I'm fascinated with this because I still have higher lows here. And I'm in a historically interesting place on the chart. But until it gets above that yellow line, though, until you get it close above that yellow line, no cigar. You're still bearish. And overall, that 4-hour pattern we talk about is so important to us, that's still bearish, isn't it? So you still have lower highs there on that pattern. But this may be one to watch. Also, your U.S. stock market, by the way, too, is going to be one to watch. U.S. stock market, very influential market for the currency markets. You see that pale green line there? That's a 382. That's the 382 of this entire up move. From here up, that's the 382 bottom. That's definitely one I'm watching. And look how you had the change of direction here. That's my lowest closing candle right there. Then you switch up. Once you have that bullish change of direction there, look at that opened up that market. So on a 4-hour chart here, and you still couldn't tear this market down. So U.S. stocks in an interesting position. This is why I know the influence of the stock market. We call it the alpha market. And that's why I wasn't so interested in that euro trade. But you know what? Shame on me for thinking. Luckily, I didn't think so much. Going back to the euro, I knew what to do when I saw this formation here on a 3-minute. There it is right there. I knew exactly what to do here when I saw that little head and shoulder top there. You can't say no to that trade. It's the pattern's down. You can see with the naked eye the pattern's down, but you know the long-term patterns are down too. So you get a shot at a head and shoulder on a 50% like that. Bam, So, know your patterns. Try to think as less thinking is better from a trader. But, until you get to that place where you can execute like that, it's something. You got to understand the basics too. It's all basics, I mean, when the football players have these mini camps now after the draft, what do you think they're following up on? Basics, basic footwork, basic repetitions. If a guy can handle the basics, that's who you want on your team because it's all rote. It's just like in the military where they teach you to feel a strip of weapon with all kinds of explosives going on around you. They want to know those guys that just follow orders. They follow orders without questioning them. And in a way, you need to question things as a trader, at least till you get the method that works for you. But no, there's a lot a lot to be said for keeping things simple and keeping things rote. You're not gonna miss trades, such as this trade today, that I would have missed had I kept thinking, and I was thinking, oh, the stock market strength, Aussie yen strength, this could be bullish for those markets. Yeah, but that's got nothing to do with the bad news in Europe, so stay on that trade. So that was a good lesson learned for me. Here, let me go back to the slide real quick and leave you guys. We've got a gift for you, as always. If you go to our site, IBUniversity.com, www.IBUniversity.com, learn to trade futures and forex, click on Core Concepts, and we'll give you our Core Concepts 1 and 2 for free. And that's it's about 3 or 4 hours of video. It's good stuff. I'm always pleased when I go back and we look at and we review the courses that we've done even a couple of years ago, how it's still spot on. I wouldn't change a thing in those courses. But you need to know all that stuff. So go to IBUniversity.com, click on Learn to Trade Futures and Forex, and we'll give you that free course too. And it's on demand video. So that's good stuff. You can access that, no problem. Hey, anyone have any questions? As always, it was a pleasure seeing you guys. Hopefully we livened it up with that example in the Euro today.